about. All right, let's talk about the numbers. $5.5 million purchase, seller finance at $4.4 million. Down payment is $1.1 million. Total CapEx, reserves, closing costs, and equity, $900,000 and $500,000. So I rounded it up. $2 million is the total raise, but that's how the capital breaks down. And this is the offering summary. Like I mentioned, we've got two classes here, Class A and Class B, $50,000 minimum. I didn't mention it earlier, but if you have questions while we're going along, plug them in the chat. And if we don't hit those by the time we get done, we're going to do a Q&A session. We'll go over all that. Okay. Projected returns, which I hit on, and we've got some more detail here. Here's how the classes break down. Class A is $250,000 minimum. Again, we're raising $2 million. We're not sure exactly how many investors we're going to have, but that we split it up because, well, we'd rather have fewer investors than more. Okay, we want to blend, but it's just easier to do deals with the fewer the better. And so if you're going to put in a bigger amount, you're going to get a better return. Preferred return, if you're not familiar with this means you're the first to get paid before any equity distributions. All right, and so basically the investors are going to get these preferred returns before we're going to get any distributions. All right, after that, it's the equity split. So additional distributions after the return will get split these ways, 70-30 or 60-40. And the hurdle, like I mentioned, this is going to come into play if we hit it out of the park. And if we really just we do a bang up job and we over deliver like we're expecting to, then we're going to share a little bit more in the upside. All right, this is example returns. Now, like I mentioned early on, I don't think I've ever heard of any real estate deal ever that has produced the exact returns that it's projected. It just doesn't happen, right? But you do your best to come up with what you think is going to happen with conservative underwriting, and I've got more of that to share. But if everything happened exactly how we planned it out, this is what that return would look like. Class B, if you were to invest $100,000, you would get that $100,000 back. There'd be an extra 116, okay? So that's more than doubling your money. The IRR calculation on that is 15.4. Average annual return is 36, and overall cash on cash return is 7.5. Class A, we've got two examples here at 250 or 500. Again, you get paid back your money first. This is profit on top of returning the capital. The equity multiple is a little bit higher. The IRR is a little bit higher. Average annual return is a little bit higher. Cash on cash is a little bit higher. And so I'm going to test life right now on the spot. Do you know what is the difference between IRR and AAR?
We're looking at different time frames. So as to the internal rate of return and your annual average return.
Yes. And to go a little bit further on that, for those of you that are still a little bit confused, average annual return is you take your total return and divide it by the number of years. All right. Here's the difference. You might have two investments that you're looking at that have the exact same projection. One of them pays you all of that return on the last year. The other one pays you all that return in the first year. Okay. Two different investment return profiles, but the same average annual return. That's this number. The IRR puts a time component to it. And so this is how you equalize those two investments. This is how you take those two that pay back at different times and compare them apples to apples. And so that's all it is. It's a slightly different calculation, but it's time-based.